and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Paul Jackson, Head of Research for Source ETF. Hi, Paul.
Hi.
So we're here today to talk about emerging markets, and I'd like to start with the big question, which is how much of a threat is President Trump to emerging markets?
Well, clearly, I think you have to look at Trump as a potential source of problems. We've seen the effect on Mexico, on the Mexican peso, and recently his actions to bring production back to the United States. But having said that, I think that the advantages of emerging markets will overcome any potential threat from Trump. For example, demographics are still much more favorable in emerging markets than in the developed world. Debt ratios are much lower, and within that debt, it is primarily domestic. There is very little foreign debt owed by most of the emerging market governments. So I think that those advantages and cheap valuations will see emerging markets outperforming developed markets once again during 2017. And don't forget, during the fourth quarter, during December, particularly on the debt side, emerging markets still outperformed, even with the election of Trump. So with that threat there, the debt markets still outperform developed markets.
So it's fair to say that you are bullish on emerging markets. Perhaps if we could drill down a little into those markets you think are going to do well in 2017, starting with debt, where are the greatest investment opportunities?
For me, I think you always need to go to the places that other people don't want to go, so where you get the best valuations. So one fantastic example that nobody really would take seriously is Venezuelan government debt. In US dollars, at the moment, you can get a yield of more than 22%. Back in 2016, at one stage, that was 36%. So it's already come a long way. But I would look for that to fall to maybe 15% during 2017. If that happens, you're looking at a full year return in US dollars of more than 50%. Other opportunities in emerging markets, I think still the Brazilian debt market with a yield in US dollars of between 5 and 6% and a local currency yield above 11% at the 10-year level. I think that is still an attractive opportunity. And in Europe, I think Turkey offers good prospects with yields that are similar to what I just quoted for Brazil.
If we're looking then at the equity side, because it is important to have a diversified portfolio, where are you seeing the greatest opportunities within those stock markets?
Yeah, once again, I think as with debt, I would take a diversified approach. But if you're looking for some specific ideas, I think China has been a forgotten market. People were burnt perhaps quite badly. It frightened a lot of people. And I think the valuations, when you look with a PE ratio below 10, it is, I think, an attractive market. Perhaps you can get it a little more cheaply in the Hong Kong market, but also looking at other markets, once again, Turkey. I think looking at Europe, Turkey has got similar sorts of valuation ratios, a PE below 10. The market has been hurt quite badly, as has the currency. So I suspect that will be a good opportunity for 2017. And if you want to get a little more exotic, looking at Africa, where over the long term, I think the greatest opportunities exist, there I think the Kenyan stock market is quite an interesting valuation point with a PE ratio below 10 and a yield which is almost as high as the PE ratio. So those would be my three picks. Plenty
of fantastic opportunities, although we should probably caveat it won't be a smooth ride for emerging markets, will you? Investors should be prepared for volatility, but good things in the end.
Of course, this is fantastic for your pensions, but I also think, if you've got that long-term view looking towards your pensions, emerging markets are a great asset class. But I do think that throughout the year 2017, you will get some good returns.
Paul, thank you very much.
It's a pleasure.
This is Emma Wall for Morningstar. Thank you for watching.